Second fundraise in just 1 year. In fact, last year it was when Swiggy did this IPO where they raised close to 11,200 crore rupees, and right now they are looking to raise close to 10,000 crore rupees. So if you look at the IPO, during IPO they raised close to 11,300, of which 4,500 was fresh issue, while the remaining was offer for sale where investors were exiting from the company. And this time they are looking to raise 10,000 crore rupees, entirely fresh issue. Price at that time was 390. Price currently for Swiggy is 402. So around the shares are trading just around the IPO price. Not much of gain for any investor who had put in money during the IPO. And yes, IPO happened back in November 2024, and now analysts believe that this fundraise will complete by the end of this calendar year, that is by December 2025. Now, why is Swiggy raising this one? To strengthen the balance sheet and to fight the higher competitive intensity that we are seeing in the quick commerce and in the food delivery business as well. So what has changed for Swiggy in the last 1 year? Let's look at that. Gross order value has increased from 10,600 to close to 15,600 crore rupees in the last 1 year. Revenues have increased from 3,600 to 5,500. But these are the positive points. On the negative side, adjusted EBITDA loss has increased from 340 crore to 700 crore rupees. Adjusted EBITDA margin has gone down from -9% to -12%. Apart from that, the cash balance that has remained largely stable at close to 4,600, but the quarterly cash balance or the quarterly cash burn has increased from 330 crore to 740 crore, nearly double than what the company was doing at the time of IPO. Now, why the cash burn has been increasing for the company? In fact, if you look at the cash balance also, even after this fundraise for Swiggy, where does that stand? The Q2 cash balance was 4,600. They got close to 2,400 crore rupees from the Rapido stake sale, and the 10,000 crore fundraise that they will do will take that total cash balance to close to 17,000 crore rupees. When you compare that with Eternal, it's still lower. Eternal has a higher cash balance of close to 18,300 crore rupees. So even after this fundraise, they're not matching their listed peer. And given the fact that competitive intensity continues to remain high in the industry, cash burn will also continue to remain high. But why is Swiggy's cash burn so higher compared to what we have seen for Eternal in the past many quarters? This is firstly because they have been entering into various non-core businesses, various non-core apps the company has launched, which has led to higher investments and higher cash burn. Also, they have been continuously seeing food market share losses when it comes to food delivery. So to maintain their market share, they have been spending more cash on advertisement, and also the losses when it comes to the quick commerce business has been widening. Now, these losses are widening, but given the fact that their expansion plan continues to remain still slower compared to what the peers are seeing. Now, if you look at the expansion plans of other peers, there are many new entrants as well. There is Amazon Now and Flipkart Minutes, and if you look at the expansion plan of Swiggy, it is close to 40 to 50 stores per quarter, while in front of that, Blinkit is looking to add nearly 200 to 250 stores per quarter. So even after this fundraise, not only does Swiggy's cash balance remain lower compared to what Eternal has, but also its expansion plan is still lower compared to what Blinkit or Eternal is going to do. Now, what are the key questions that we would ask the management here? Firstly, how they are planning to deploy this capital or this fundraise that they're looking to do. What's their path to profitability, and what are the measures that the company will look to take to cut down the high cash losses that we are currently seeing in the financials? And lastly, will the company need more fundraise going forward? Would be the key questions to ask from Swiggy when they are coming in with this fundraise of 10,000 crore.
Yeah, well, we hope we have an opportunity to ask some of these questions to Swiggy on what exactly is this cash raise for. The stock cooled down a little from its opening. There's a positive Novama note which has initiated coverage. Maybe that's what kept it bumped up a little. Rahul Jain with us, Director Research at Daulat Capital. Rahul, thank you for your time. I know you stepped out for a meeting for this quick chat. You know, we did a bit of analysis on Swiggy, and Soumeet Sarkar has put it together really well, including the questions that need to be asked. How are you looking at the fundraise?
I mean, as you know, just extending to some of the data which was shared earlier, I think this is required because the way the QC business has been evolving, we are seeing that it was a quite comfortable business a year ago in terms of the number of participants. But in this 1 year, we have seen there is a significant amount of competitive intensity brewing up in this space, and which is resulting into a lot of changes that is required. Firstly is how people want to now go into the inventory model versus the marketplace model. which would mean that the foreign ownership has to be sub 50%, and that's where the fundraise is also needed to ensure that. And also, secondly, to have extraordinary expansion that all of these players are going about, because there is a lot of new entrants from the e-commerce space who have the scale opportunity and now trying their hand on the QC business. So I think fundraise is the need of the hour, given the competitive landscape.
Okay. The question is about valuations of not just Swiggy, but also in extension Eternal. And ultimately, the argument that some people have made is that there is too much uncertainty in the space. What is stopping a completely new player that has the cash to burn coming in and completely disrupting the space? It's not something that is making money on a consistent basis. In fact, they are continuing to burn cash. We don't know when that will end. So is that something that you should accept if you're wanting to be part of this story for the long term?
Yeah, I think the cash alone does not solve the purpose for the new entrant. They have to have the good customer. If you see any new player that would come, will get a lot of incremental customer who may not have a similar AOV or frequency profile. So obviously the advantage of incumbent will remain in terms of the quality of customer they already have. I think the capital requirement is required more to give or kind of discourage other people to enter, that they are enough capitalized. For the person who is looking at this space, the person has to think about that this competitive intensity is not going to slow down in 6 months or 12 months. This is going to be a long battle. So of course, anybody who's looking at this space as an investor or as an participant has to be prepared for a much longer battle.
If it is a Swiggy versus an Eternal, where is the buy call? Is there a buy call on either of them? At the end of this conversation, viewers would want to know, what is the takeaway? What do they do with a Swiggy right now, if they own it, or should you come in and buy?
So we have not no rating on Swiggy as such, but on the space we've been negative. Eternal, we have a negative view for quite some time. We think the kind of a competitive intensity is going to be there for some more time. The path to profitability would be much longer, and that would test the patience of the people, and that's why making an absolute return in these stocks will be very tough from a 12 to 18-month perspective.
All right. Thank you so much, Rahul, for taking the time for joining us this morning to talk about this update.
Thank you.